are live. All right, welcome back to Money Moves, hosted by Millionaire Mindcast. As always, it's good to be with you guys. Mr. Ryan Breedwell, myself, Matty A, talking stocks, real estate, crypto. We like to sprinkle in a little politics and social culture. What's going on, brother?
Man, I had a very interesting week and weekend because we had a pretty good week in the market. Things were looking volatile but good, and I'm like, oh man, we're going good. Things are nice. Then Saturday we had news of airstrikes in Iran, and so I was like, oh gosh, Monday is gonna be terrible. Tuesday is gonna be pretty volatile. Surprising start to the week so far. A positive, I would say, surprising start to the week. I was expecting to have a bigger pullback.
Yeah, it was nice. I was touching some grass. I wasn't paying attention. I was up in Washington with the family.
Saw a wedding?
Yeah, for my buddy's wedding, officiated it. And that was fun. Had a nice little message in there for, I always feel like the greatest officiants always have like a good message that relates to not just the bride and groom, but everybody in the audience. So I was preparing that speech, just spending time with the family. We hit up Seattle. We went and checked out the Space Needle.
Did you see the people throwing the fish?
Oh yeah, we were right in market.
That is too legit.
Yes.
Did you see the OG Starbucks?
We saw the OG Starbucks, little hole in the wall. It's so tiny.
I like that logo way better, the original one.
It is pretty cool.
Way cooler.
So we did all that, and I saw this quote today on X. Harvard tracked 724 men for 75 years. The number one predictor of health, wealth, and happiness was not money or fame. It was whether you had one or two ride or die best friends.
I'm going to the fucking dirt, baby.
I'm
10 toes down.
I was just thinking about that. Like, obviously, you and I and all the amazing things that we've been able to do with not only us, but then our families, now our kids. I was thinking about my friends and like all of the seasons of life that I've gone through. And it's like, man, there's just some things that money can't buy, right?
Mm-hmm.
But like everything, it requires investment, it requires reps, it requires constant attention, showing up consistently. So yeah, it was a fun weekend, and I did see that there was some conflict, sparking up again. I didn't really dig into why.
I was hoping it did again. But I'm very happy that
it's interesting to see how desensitized the markets have become to some of this. Like, oh, this is just kind of par for the course now.
Well, we got there a lot quicker than we did with the Ukrainian war that's still going on 4 years in with Russia. So I'm not used to people digesting it that fast. But there's a downside to how fast information moves. And then there's a benefit, which I would say is this latter part.
Right.
How fast information. All right, fine. We need something new. We need something coming up. We got midterms coming up. The end of the quarter, Q2 for stocks moving into Q3. So I just think people they get really tired of news and they want more news fast. And that's a product of the overall news system constantly pumping mostly BS to people.
Yep.
But they want to feed off of it.
Yep.
So when you constantly feed people that, they just want more and more and more of it. We did have a bunch of Supreme Court rulings this week. Some were good, some were bad. I would say the strongest ones.
No men and women's sports. I'm down with that.
That one was really strong. We had probably the birthright citizenship was a little more split. Trump administration wasn't too happy about that, but they said they're going to go about that again through the legislative branch through Congress. And I forget there was like two other ones that were pretty strong, but regardless, an eventful week. Tomorrow is going to be a big day for U.S. stocks, real estate investors at large, the economy, central bankers, really everybody. It's the first time we're getting an unhindered speech after the initiative speech of Kevin Warsh. So he's going to speak tomorrow. There's no dot plot. We already got that kind of stuff. But we did get confirmation that it was him who dissented and did not, I don't even know if dissent is the right word. He who did not put out any projections for inflation measures. I'm giving rough numbers, but I looked at I looked at it again really quick before we came here. The dot plot. I think it was like 9 or 8 want one cut, 6 want cut. Excuse me, one hike. 6 or so want 2 hikes, and 9 central bankers want no hikes, no cuts, and just a hold. To me, that's probably the most likely moving forward, even though I've been on my rate cut horse here riding into the edge of a waterfall. But that's probably what's going to happen. The thing that just sucks about that is the stock market and the real estate market on the retail side, residential and commercial side, both could use capital injection, because right now we're kind of grasping at straws. We have 2 or 3 catalysts over on the stock market side. And in real estate, I mean, I think they would take anything right now.
I mean, it is drier than the Sahara Desert, in the real estate market right now. I mean, this has been the most stale, slow, boring real estate market I've ever been a part of. I mean, I obviously got into the game in 2010 when you could sneeze and stumble into money if you had the ability to find deals and creatively structure opportunities, and you were just hustling, right? I mean, you could just in those kind of markets, you can make mistakes and still come up big. This is the complete opposite of that market where almost everything's gridlocked. And if you are going to do something, you got to thread a needle, and it's got to be dialed in on point. So I know many people are hoping that, we're going to get some kind of, which he said, don't expect too much forward-looking sentiment or insight. So I'm curious if he's going to stick to that narrative, or if he's going to maybe hint at some things or give us some idea of what direction things may be going, here in the future. What's your thought?
I think he's going to stick to his guns. I don't think he's going to set us up. I think he's going to stick to his guns. I don't think he's going to set us up to where every meeting we're waiting and we're making bets, 120 to 90 days out to the next Fed meeting. And then even though the market and earnings are good and this and that, we need to focus on what the Fed chair says. I'm happy to get away from that, as much as I want him to still talk in a similar way. I won't mind if he speaks kind of like how Powell did, but I don't want him to be as black and white. I'd like to let him let the market go and see where it takes it, and let the data just drive everything.
Yeah.
Because if we get back to that, policymakers are less in control of what happens in the stock market. That's a good thing for investors. That takes legislative risk much more off the table, even though it's systemic. And then it puts the data much more in the front view, and then maybe we can start updating how we look at data, which I've said for years is the wrong. We're like driving forward but looking in the rear view mirror versus we have the technology and ability to see things as they lie.
Yeah.
So to me, that's really where the linchpin lies. And we're kind of focused on the wrong thing. I think Warsh can help us get back to focusing on, are we digesting data the proper way? Why are we looking at stuff that's 3 months old when we can just look at it right now? Why are we doing that? So I think that's going to maybe hopefully be where that leads us to.
Yeah, because it puts, at least the data that came out last week and what we've been seeing come out does put the Fed in somewhat of a tough position to cut rates.
They can't cut rates or raise rates.
Right? I mean, right now you've got, let's see, so PCE spiked to 4.1%, which was its highest level in 3 years. That was the data print last week. Core PCE is at 3.4%, which is its highest level in 2.5 years. Then on the other hand, GDP data, as you mentioned last week, came in strong, came in at 2.1%, which was higher than expectations. And really the only reason that the Fed would have cut rates is if the economic growth had slowed, which obviously isn't the case. With AI spending, we've seen job numbers have continued to hold strong or even improve and get better.
It's keeping pace with the trend in the market right now, which is important. I wouldn't say it's a strong labor market, but it's stronger than people are anticipating because it's not wavering.
Yeah. Now, last I checked, rate hikes this year are up to 85%. I don't know if that's come down a little bit or not since I last documented this, but in general, right? I mean, the overall concerns around, are we going to see some liquidity and rate cuts and cheaper capital kind of come into the market? That narrative is really fading a little bit. And more of the concerns and the volume getting turned up around rate hikes is starting to become a little bit more prominent. But to your point, you mentioned as quickly as it can come in and, show on the recent prints, this type of inflation, from what you're saying, can also, shed off as quickly as it arrived. Is that still something that you feel like the markets are slowly kind of come to terms with and digesting a little bit as well? Hence why we're seeing, stock market still do what it's doing.
Yes, I do. I think that, again, touching on what we were just talking about, one of the reasons that we might need to update on how we look at data is, why are we taking into, if oil and energy costs have such a huge impact on the short term inflation numbers, then why are we weighing them so heavily when we have a conflict over in Iran? It may be for the short term, but we don't have a buffer built in for that. And so now we go and we have a revision down of super important numbers. They're going to do the exact same opposite here in the next 4 to 6 weeks. They're going to revise them back up.
Yeah.
Because oil prices are now, 30-40% cheaper than they were 3 weeks ago when that data was gathered. So it's just not accurate to the time. Did it happen? Yes. Is that going to be in the print? Yes. Is it applicable to what we're actually seeing going on, though? No. Oil is at $70 a barrel as of market close today. Not 95, not 105, not 110, which is where it was trading.
I mean, even after, a weekend of, new fresh bombings and more concerns around escalation, the market, specifically oil, is saying we're not as concerned about this continuing on as, I mean, the pricing is basically where all the money is shown, where people really think the sentiment is at, right?
People are putting their money where their mouth is, hence the saying. So, yeah, big traders are probably looking more so at the traffic in the Strait of Hormuz and saying, is this normalizing? Is this getting back to where it needs to be? They're tracking updates on the conflict resolution, and is that getting settled up? And that's still going to be 30 to 45 days out before anything happens there. So this is going to be a continuous cycle we're stuck in for the next month and a half. But the market's essentially shrugging it off. It's telling us that it doesn't care that we are going through this conflict as much as it did a month ago. I think that the pullback last week was traders repricing in the fact that there's probably not going to be a rate cut this year as of now.
And less about the conflict.
Yeah, I think that they're refocusing their crosshairs on AI again. What's Warsh going to say, and how is that, how is he going to run his meetings, and how is that going to give us indications of what's going on moving forward? Because we've been so reliant for the past 8 years on a completely different way of doing it. So yeah, that's really what the market is waiting for, but it's telling us that it's allowing us to shrug off the conflict notion that that's holding so much weight anymore. I don't think it is. I think if people continuously see prints on inflation going up and up and up, that will concern traders. But what probably is going to happen is we're going to see a big snapback down in inflation data, both on PCE and CPI, and that's going to cause another pop in the market because traders are going to then start saying, "Oh, maybe cuts are back up on the table," and they're going to start betting on that. You'll see futures move a little bit to the cut side, maybe saying, "Hey, pause is likely, cut is likely, hike is likely," and that might just ride out through the end of the year. But I just don't see right now, if we're using the rules-based model that I know we are to make decisions, there's nothing in the cards for either camp. As much as I want mine to win, there's no way for me to win or lose. Everybody's at a stalemate.
Yeah, that's crazy. Well, to recap, I mean, Q2 2026 was a pretty historic quarter for the stock market.
It's the best in the last 6 years.
So S&P 500, and this, there could be a few adjustments to these numbers based on when I am sharing them with you when we documented this. But the S&P 500 is up 14% so far this quarter, on track for its best quarterly performance since Q2 of 2020. This would mark the second largest quarterly gain since the 2008 financial crisis recovery. At the same time, the NASDAQ 100 is up 25%, on track for its strongest quarter in 5 years. This would also mark the NASDAQ 100's second best quarterly performance in 25 years. And U.S. stock gains have also fueled a global rally, with MSCI All Country World Index, ACWI, up 13% so far in Q2, on track for the biggest quarterly gain since Q4 of 2020, which obviously we know the amount of liquidity and capital and what was going on post-COVID.
Stimmy checks.
The global equity rally seems to be continuing to not only, kind of reach new highs, but it also seems to be accelerating and building up some great momentum going into Q3. Is this something that you think is going to continue into Q3, or do you believe there's going to be some of that pullback, some of that profit taking that you kind of mentioned in, potentially seen towards the later half of the year?
Right now, I wouldn't be surprised if there was a pullback in the Q3, beginning of Q4 area. That doesn't mean we don't have a run up until then, and that doesn't mean there's going to be a pullback. That just is a timeline that looks like it could happen as of now. But if it does happen, what the charts kind of look like is that it would be very fast. And it would quickly be bought back up and then some. So we would have a very strong rally back to where our par level was, and then some before year's end. Maybe a really strong Santa Claus rally, because in my opinion, that missed us last year.
So JP Morgan warned extreme retail leverage is starting to unwind, potentially triggering a multi-month tech stock correction. Do you see any of that? You see any merit in that statement?
I don't know. I don't know if it'd be multi-month.
You think it'd be shorter lived?
Yeah, maybe multi-week, but multi-month, I don't see that happening. Not right now. Not right now. I would say multi-month would line up more so with the thesis that I would have if there's heightened volatility. But that would just provide opportunity and entry points for traders, and I would remind everybody how much money is still sitting in money market accounts waiting for entry points right now. So
why hasn't it come in with all of what seemingly has been great entry points in this run up? Has it just been because it's continued to run up and they really want to see a healthy pullback to feel like that entry point is a little bit more palatable? Or, like, with all that money sitting on the sidelines, I guess, what would you say? What is it waiting for? What is it looking for?
Well, typically when we see a movement like we have in the stock market, we're going to see interest rates moderate. And so that naturally forces people off the sidelines that are holding in yield-bearing instruments, where they'll typically start seeing interest rates be reduced. But interest rates have been pretty flat and sticky for the past year now. And so you're still getting 3.9 to 4.2% risk-free in a money market or high-yield savings account. Why would you jump into the market, seeing that even though it's ran up a ton this quarter, look what it did last week and the week before? That makes investors nervous that don't have a stomach for volatility. So for me, it's just people saying, you know what, I would, but I don't need to because I'm getting 4% right here. And that's beating inflation overall. And my money's safe and it's fully liquid and I understand it. So we were just throwing what they know. I've ran into 3 new clients this week. Consecutive between the 3, maybe 1.6, 1.7 million, almost 100% in cash. For the past couple years,
They've been sitting in cash?
sitting in cash. Yeah, because
Why? Well,
they saw the 2022 happening and it just scared the hell out of them. And then they just saw interest rates going up and inflation. So they just said, cash is good. We're getting higher interest rates. They've been buying CDs. That's what I'm seeing a lot of people do right now because they don't know what to do. We have solutions for that. And there's also, at some point, you got to take some risk with some of your money, or else we're just, we know I run these financial plans for them. And it's like, you have a 1% chance of plan success as you're currently set up. Or we can do this. We can take about the same amount of risk, but be smart with it. You got a 96% chance. It's just people don't know how to do the right thing the right way.
Yeah.
So they say, you know what? I understand cash. I'm going to go to cash.
Hey, what's up, guys? I'm so excited to announce if you are an investor looking to generate consistent passive income, then I've got something for you. I just launched the Imagos Income Fund. It is a private investment debt fund. So instead of relying on long-term appreciation or big exit events like most real estate syndications do, we decided to keep it simple, focused on first position asset-backed lending just like a bank, meaning your investment is backed by real collateral and structured to produce income from day one. The target return, 10% paid out annually and also paid out monthly. So no guesswork, real passive returns, true mailbox money. And because we're in the debt position, not equity, we're able to prioritize downside protection, maintain shorter durations, and stay in control of the risk, which is most important in environments like this. This is built for investors who want steady cash flow, strong capital preservation, and real asset exposure without the headaches of owning, managing, and waiting years for a payoff. So if this resonates with you, if you want to learn more, I put together a full investor presentation breaking everything down. All you got to do is just text the word income to 844-447-1555. That's income to 844-447-1555. I'll send you everything so you can see if it's a fit for your portfolio. Those plans that you do for people, and for those that aren't aware, Ryan and his team do these really cool plans based on your goals, your risks, what you're trying to accomplish, when you want to accomplish it by. They do it for any of our Millionaire Mindcast family. Watching Money Moves for free. So you can text the word X-ray to 844-447-1555. Tone will throw that up on the screen. But that's a way to connect with Ryan and his team. But how many people follow their financial plans that you guys do for them? And what's the overall success ratio, or delta variance between those that do and those that don't?
So the ones that follow the plans, this is my experience. We typically will show them doing a plan and getting a rate of return that is quantifiable. And then we look back, and I'm looking at what's called time-weighted average, which is an annualized rate of return that takes into account fees and inflation. And we're beating the annualized return we put on the plan, which doesn't take that into account, just takes account fees into it. And so we're ahead of where we needed to be. We've had really good markets in the past couple of years that's helping with that. But typically when people stick to a plan, it works. It's very similar to like a workout and diet plan. It sometimes gets hard and it's not always fun,
But it's pretty simple.
but it's pretty simple and it's rewarding. It just takes repetitiveness. So high success rate, I would say. How many people do it? Over 95%
Okay.
end up sticking to their plan and do. And people have questions and they have concerns. And okay, this is that first time we're going through some volatility. Is everything still okay? And we just go and refer back to the data and then look at what's going on. And it makes it more clear
that this is all part of the plan.
Yeah,
all part of the process.
It's more scary when you have investments, but you don't know what they're doing.
Yeah.
Versus like I have investments and a plan, and I already saw that, in the next 25 years, I'm going to take 9 or so loss years. And this is within the ranges that I looked at. So I'm okay. Yeah, we didn't know it was going to be this year, but hey, no problem. It's part of my plan. It's not a big deal. Maybe I'm educated enough to know this is an opportunity to buy stuff that I want to hold long term.
Yeah.
That's how I try to educate my clients to think. And so that my phone doesn't also look like a Christmas tree.
Anytime you get a little.
Yeah. I get questions, and that's fine. It's mostly from newer clients that I've onboarded.
That makes sense.
Most of my seasoned clients are like, hey, can we put money into the market? Hey, I put in, like last week, I put in like $5.8 million
Into the market.
From people saying, hey, put in 50K, put in 100K, put in 140. I still got 2 more transactions for another 270,000 to put in when I get home. It's just what people are doing, because I've told them if we're buying at 7,200 a month ago, and here we are today, and it's at 7,200, What do you think is a good idea?
Mm-hmm.
Probably to buy at 7,200 again.
Yeah.
I'm not worried that we're back at 7,200.
Yeah. Now, I saw a recent interview with Warren Buffett. He said he's waiting for a bigger drop in stocks, saying March was nothing. I'm curious on what your thoughts or takeaway is from this soundbite, and if it kind of relates or aligns with what you were saying as a potential pullback or correction at some point this year.
The market has come down substantially.
Not substantial.
Well, you've got both the Dow and the NASDAQ in correction territory. It's the worst performance on a quarterly basis for stocks in about 4 years. Do things look cheaper to you?
No. 3 times since I've taken over Berkshire, it's gone down more than 50%. I mean, if you look at the markets of
It's got to be old.
the worst, probably was the 2007-8 period, although
Yeah.
it was that one Monday when you had 21% in a day. I mean, this is nothing. I mean,
This is the
This is nothing to make you get excited and think there's huge valuation.
they're 5 or
the wildest thing is
So that is an old video, but to his point, I seen him do a couple different interviews saying like he's expecting a bigger correction or a bigger pullback. That's hence why they're sitting in so much cash. What are your thoughts around that? And does that feel more like a timing the market kind of thing, or I mean, what's your take on his perspective around? And obviously, this is a little bit outdated too.
I think that he has a good, perspective on that. We have a lot of cash and we want to put it to use when we feel the timing is best. It is, to me, he's been saying that for a long time, and I don't dislike him. And he obviously owns and holds long, just like I do, for quality. But I don't want to get caught up in, pointing out when investment managers don't pick the right stock at the right time, because we do the same thing. What I would say is, I think that looking back a year now, he would have said, darn, we missed out on 20+%, which our cash did not make us. And that's probably a big enough buffer to where we could have taken some profits, paid some taxes, and been off in a better place if we would have. So in hindsight, I bet you he regrets that. What he is saying then, though, I think is now more applicable. And if we did have a pullback to the level that I think we did, we would probably see 65, 64 numbers again on the S&P before we hit a bottom. And we would get there pretty quick. So and that's not something that should scare people. That's something that should just let them know that this is the next bout of volatility that's coming. And you just need to be better prepared for it. It's when you understand how normal volatility is, it would be like living your life as a normal, healthy adult and dreading the day that you're going to get a flu or a cold again.
Yeah.
Knowing you can just go hydrate yourself or take some over-the-counter medication if you're really not feeling great, and you're going to get through it. It's not going to be really fun, and you're not going to write a book about it and say, man, I'm so happy I did that. But you're going to be fine, and life will go on and will continue. That's how people should really look at, on my side of the street, I know on yours as well, that's how people should look at investing in equities and in a portfolio. It's not something that you treat like a slot machine. It's like, okay, hey, a little bit of volatility, opportunity, just like when we have a pullback in the real estate market like you got into in 2010, that was opportunity. Yes, people felt the brunt of that, but a lot of people stepped in and used that as the way to start their investment careers. Here you are. So to me, that's what the same thing happens in the stock market. You just have a lot of people on both sides of the street that will preach against real estate and that will preach against stocks because there is volatility. But that's really the secret sauce of why it works.
Yeah, agreed. Now, as we wrap up a little bit on the stock market, financial markets, the U.S. chip stocks are on a historic run. I mean, we've got, I think Micron is officially the most traded stock in the U.S., has been a key driver, rallying 301% over this period, making it the largest contributor to the S&P 500 gains this year. SanDisk soared 764% in H1, making it the top performing stock in the index year to date. We saw SOX has rallied 94% so far and 26% compared to 9% increase in the S&P 500. What are your thoughts? I mean, this would exceed the previous record set during the dot-com bubble in H1 2000 by 15 percentage points, with the semiconductor index, which is SOX, has outperformed the S&P 500 by 85 percentage points year to date, on pace for the best half-year outperformance in history. Has it run its course? Is it topping out? Or do you think that this is an evolving sector of the stock market that is going to continue on this run that it's been on?
Well, I love to hear you say that. We bought SOX for a lot of clients like last November, or no.
And explain what SOX is for people that don't understand.
Semiconductor focused ETF. Has like
It's a bag of all of the sexy semiconductor stocks and
AI and chip names.
okay.
Yeah. I think it has like 9+% in Micron. I mean, like 8 or 9% in NVIDIA. I mean, it's really heavily concentrated
On the big boys.
So you get a lot of the movement in an ETF. We bought it. I think I'm averaging for most of my clients somewhere around 125, 150% average rate of return on that ETF that we own for them. It's a great ETF. And a lot of other clients, we have BAI, which is the BlackRock AI ETF that has SpaceX in it. About 4% of it SpaceX, has Micron, has NVIDIA, has all these big AI play names. The thing that I think is funny is we're actually really early. A lot of people are like looking for the finish line, and I would say we're at like the gun has just shot off and we're just getting to the first turn.
Interesting.
So we don't even really, and what I mean by that is like in a true race, how the current leader might finish last,
Mm-hmm.
and the current person in last might come around and finish first. So it's
Right.
still a really active.
There's a lot of race to be run.
Oh yeah,
Interesting.
and nobody.
So even though this is being labeled as a historic run, you still believe that this is really the beginning of the race, and there's a lot to be discovered
There's another NVIDIA or another Apple.
about who the real winners are going to be.
Yeah, somewhere. I mean, if you think that the movement in Micron or SanDisk or whatever is big, I have a client that literally put like $6,000-7,000 into Apple in the early 2000s. It's worth well over 1.5 million now. Never put another dime in it.
Wow.
So that type of movement is going to happen year after year to something. Then one of these names is going to catch on to like a catalyst, big like the internet, like AI, like the next robotics chip, exactly. And they're going to run. Or one of these big companies is going to buy them, and they're going to continue on their run. So it's a different market we exist in now than 20 or 30 or 40 years ago. The people have information to act upon quickly. Right here. They can do it right here. We do it for our clients, and they don't fret the volatility as much. I would say they chase it. You have people holding on through short squeezes. You have people democratizing stock trading so much that we have GameStop now is a well-diversified company, which started out as a meme stock.
Yeah.
Now a strong, on paper company. I mean, potentially might buy eBay.
I saw that.
That still might happen at some point. So, I mean, like, you would have told me that 10 years ago, and you know what drove that? Retail investors.
Yeah.
The power of retail investors is so strong. And although they're not as correct as they want to be, God bless you all, they're a powerful thing.
Yep.
And so,
well, and more powerful in today's world of technology and social media, the speed at which these communities transfer and share information, how virality, exponentially compounds attention into. I mean, I was just this last weekend, Tone, I was telling you about the market bubble guy. It was like Phase Banks and this guy named Ansem. And I've, been playing in crypto world and just listening and, investing a little bit here and there. And honestly, just learning and taking all of this in. And there's this dude named Ansem who, previous software engineer, has built a significant amount of wealth, is one of those big, crypto influencers. And talking about virality, I mean, he created his own coin, this own token, and basically ran from call it over the course of a couple days, nothing to 100 million market cap. And so, I mean, people that were, this was, I think it's up 60,000%, something like that. So, I mean, there's people that are, thrown in a couple $1,000 and turn into multiple six figures into some of these things. Now, most people get wrecked, right? I mean, this is true gambling, and there's a lot of scamming that happens depending on if there's, the tokenomics of these things and who's bundling and holding them and controlling the supply and all that. I mean, there's a lot of stuff that obviously leads to a lot of people just getting rug pulled, and that's part of the problem with the industry. But just to talk about, right, the power of retail catching on a narrative, let alone a real company. This is just a meme token.
Yeah.
Let alone a real company that gets that attention, has real, merit to their business model, real revenue numbers, real utility and value in the world.
Billions of dollars in cash in a bank account.
Yep.
It's pretty impressive. I'm not going to lie. AMC, second to them. I thought AMC would be better actually than GameStop, but GameStop made the deal with PSA. So they have huge amount. They're riding the back of the collectible waves right now, which is, that's another one that's not going to slow down.
I was going to say, I mean,
at all. That's also, people think there's a bubble there, and I would argue that. They have video games coming back into play. You have a remake of Zelda coming out. So that's a huge thing for Nintendo. They're positioned super strong to what they used to be. I mean, they are probably one of the best structured companies for what's actually going on in young consumers today. Best company, GameStop. AMC is kind of second to that. Both, my point on both of these is they started out as meme names. The reason their stock prices ran up was a short squeeze, not because they were a quality company. And what they do, they said, hey, it's 2023, 2022, 2021 when this stuff, let's jump onto this and ride this wave and make this our business model. Let's let the people decide what we do. And they did. AMC's the most popular movie theater brand in the United States. GameStop is the largest card grader submitted to PSA, and they get a piece of all of that. They don't do anything. Do you realize that? For you people, they just have a brick and mortar for you to walk into. So somebody said, hey, people get nervous when they package up their cards that are expensive and they send them into PSA. Why don't we just make a store that people has goodwill value so they trust it? They don't actually do any of the grading though. They're going to package it right in front of us like we can do at our house with rubber bands and cardboard. I shit you not. And then they make a few dollars off of every card. But do you know how many cards are submitted every week?
Tens of thousands?
Millions.
There you go. Yeah, that's crazy.
It's not even, at this point, it's hundreds of thousands because I think there's been a tier shut down at PSA, but that type of thinking originated from retail investors getting involved and buying them because they like the stock. If you remember that line, because I like the stock.
Yeah.
And now it's transformed that business into what it is today. An absolute money printer.
And it doesn't seem like it's going anywhere.
No, it's not. They're going to absorb some other type of business in that, and they're going to continue to grow. Then there's another company somewhere out there that we don't know yet, but that's going to happen too as well. It's probably going to be a financial services company next, is my
If you were to
guess.
take some insane, wild, outlandish guess, does anybody or any particular brand or company come to mind? Or is it truly going to be one of those that nobody's even heard of it yet?
I don't think it exists yet, and I think it's going to be backed by something like a Ripple. It's going to be a disruptive, hey, we're big enough to be our own entity. We know how this thing works, but it also could be a bank. I don't know. They're going to have to shoot themselves in the foot for their business model and force the whole industry to change. So I don't know who's going to do that, but that's who I see this that happened in retail, low-end retail consumer goods. The next thing that people are going to try to democratize and get their hand in and make it their own, and this type of business for the people, some sort of financial services. We already have that with, hey, link your W-2 to this app and we'll pay you early.
Yep, kind of cash advance
with no fee.
Mm-hmm.
Let's take it a step further. What if we have banking that pays you a better interest rate? And what if we're more transparent on our products? And what if we have loan products with no origination fees because you're already our client? I don't know. Things that don't exist that.
Well, this is where the blockchain
model
and tokenization is creating a real platform for these types of ideas and business models to advance.
Correct.
Right? I mean, we just saw this week in crypto, major financial firms, including Visa, MasterCard, BlackRock, Coinbase, and American Express are going to launch a joint crypto stablecoin called OUSD, OpenUSD, which is launching natively on Solana from day one, which you've been saying ETH and Solana are your two that you like long-term because of their L1, layer one capabilities for creating real value for the projects that are built on top of them and the ecosystems that are built out of them. So this is going to be a new shared stable coin owned and governed by its partners, no mint or redeem fees, no volume caps, and nearly all the reserve economics flow back to the businesses building it. So again, just another example of this technology, this transparency, this reduction in friction or fees. Like when you talk about the scale of some of these businesses and what they can do, and then you talk about how that transfers down to its shareholders, compressing fees in one particular vertical of the business could mean a massive jump in valuation of a company, let alone multiple verticals or multiple industries that they're servicing. So I can see, to your point, right, the technology, the efficiencies, the transparency, the speed. There's so many tailwinds. Again, if we can get the Clarity Act passed and some more legislation and some of the, the headwinds that have been working against some of these industries and some of this technology sorted through in damn near every vertical of every business and industry that these things can get applied to.
Correct. And I think that's like in real estate, cost seg is kind of that similar idea. Like how do we aggregate all of our expenses and taxes and make things make sense more on paper? I think the same thing's going to happen with technology. It's going to cut the fat off of inefficient spending. I think really where it's going to do is it's going to cut a lot of jobs that are not needed.
Yep.
And that will lower healthcare costs. That's what a lot of people don't want to say, but that's really where the biggest savings are going to be. Not having to hire a human to enter data into a spreadsheet, because you can just tell a program to do it and it doesn't mess up, and it does it on time. In fact, probably does it instantly.
Mm-hmm.
That's where the biggest savings is going to be from AI. But as a job goes away, a new job will appear. Don't need people to manage those systems. So it's just it's an evolution of that workflow and work process. But it's very exciting because, especially like with the robots and humanoids, just like what they'll be able to do. I mean, roads getting built super fast and efficiently, safely, because workers aren't having to be standing near traffic. It's just a big leap forward. Anywhere you apply it, and like everywhere you apply it, it works really good. The spaces I don't see it, like You're not going to lose realtors. You're not going to lose financial advisors. You're not going to lose doctors. You're not going to lose trusted voices, and that's not going to go away. But what will go away is I don't want to pay somebody to do all my yard maintenance. So there's this company you can pay 1/10 of the cost, and they have a humanoid robot team because they don't have to pay them, and they go around and do it.
Mm-hmm.
That's the type of and it's better, faster, more efficient, not afraid of dogs, all sorts of fun stuff. But that's where the world's going to, and that's exciting because we're going to be living through it. And our generation. Even you're 89, right?
88. Yep.
88. Yeah, we'll let you come into the 90s. The 90s and really late 80s generation is the last generation to have analog to digital.
Yeah.
We got it all, and we've seen the past, and we've seen the transition. We're the best generation to go through that because we have a good broad taste of what it's like to not have technology, what it's like when technology gets implemented, and what it's like when it starts working, versus newer generations, which are like all digital. Everything's digital. We don't get analog. What's a VHS? What's a DVD? Things like that.
Yeah, going to be interesting. Now, wrapping up on crypto strategy, Michael Saylor said that it may sell up to 1.25 billion in Bitcoin. Sounds like
they filed. They're going to sell it.
So that continues to depart from his overall sentiment. That
he's saying I never said I would.
Yeah, he's saying you shouldn't,
but you should never because it keeps my price high. That's what he's actually saying. If you want me to translate it for you,
what does this say about Bitcoin in the short term, or maybe even in the long term? I mean, there's obviously a lot of attention and capital that's moved away from Bitcoin over the last, all-time high was 126 in October of last year, 25. And it's just been on this slow bleed to where I think today we're sitting at a little north of 58K. A lot of people still believe that there's still more room to go.
How many years have they been saying like 1 million?
When you've got guys like Saylor who have, been the Bitcoin maxis and really become like the key face of Bitcoin, now kind of departing from that narrative for so long that has propped a lot of confidence up behind Bitcoin. How do you think this plays out for Bitcoin short-term, long-term? Is it going to go to zero? Is it going to find a bottom somewhere in the 20s or 30s or 40s and, creep back up to new all-time highs? What do you think?
I don't know if it'll go to zero. I just don't know if it'll go to like 1 million. Like,
Could you see it making new all-time highs in the next 12, 18 months post bear market?
All-time highs, like,
Past 126?
I don't know. I just don't think the adoption is going to be there. Once people see tokenization and how nobody tokenizes with Bitcoin, it's going to be another reason why it's like this whole system's moving along. And for some reason, people are just stuck staring at Bitcoin because it's the most recognizable name. But I think it's quickly losing goodwill value to Ethereum and Ether-based projects. And my point how would I put that out there? Bitminer is buying, not selling. And the biggest holder of Bitcoin is selling, not buying. So that's my thesis. And just announced today, the stablecoin thing that I've been saying for years. I don't know how far back, 3 years at least, I've been saying the major banks would just get together and make a stablecoin. OUSD was announced today. BlackRock, JP Morgan, all the big banks, they're just going to have their own one stable coin that they all share together. And that way they still have control over the asset. And I told you guys that was going to happen. And that has now officially happened. What's probably going to happen with Bitcoin is slow but surely people will continuously stop adopting it. And you're going to see Michael Saylor do exactly what he did in the early 2000s. He's going to BK his company again.
Is that your bold prediction? Michael Saylor is going to end up BKing MSTR.
Yep.
And have you been paying attention to what it did on the run up and now what it's been doing on the bleed?
I don't not maybe in the same way that you have, but I know that in the run up, they were talking about how they were so smart and look at my strategy and look at how it's so good and look at the yield that we can pay. And now it's, hey, you guys don't sell, you hold. We're going to sell Bitcoin so we can continue to pay this 12% yield on Bitcoin. Yeah, it's just stupid. It's not sustainable, and it's going to eventually. It's going to collapse pretty hard when it does.
Oof. Well, that'll be something that we will be paying attention to, and your prophecy might come right on that one. That's one that I could definitely see playing out. Shifting over real fast, we're going to wrap up on a little series today called Run the Tape. So I'm going to run some videos for you, and we'll get some thoughts and comments on some key things around stocks, crypto, retirement, investments, raising family around money. Some interesting, fun topics for you guys, because these are all things that you guys reach out to us on and ask questions on. So now, real estate real fast. U.S. housing market has reached its most unaffordable level in history. Nothing new there. Pretty insane that, we continue to see this be a repeatable headline every couple of weeks. Nearly 1 in 2 home sellers are cutting deals to attract buyers. Home sellers now outnumber buyers by 630,000, which is the largest gap ever. I think last week or 2 weeks ago, I said it was 600,000, largest gap ever, right? So it's like we continue to play these little narratives out because there's really nothing to talk about in real estate right now. Now, if you can make deals work right now, like we said in last week's episode, when rates do cut, when demand does come back in, because right now, obviously, with the returns and the risk tied to the stock market, AI, semiconductors, everything. The stock market has the perfect storm right now for anybody that's got dry powder, a risk appetite to want to park their money there versus crypto, volatility. It's a ghost town. Real estate, it's too much work for too little return, for too much risk. And while I do believe every asset class has its day in the sun, right now crypto and real estate are in a very stale and challenging season. But with real estate, I do think that when we do see some easing of rates, some liquidity get unlocked, we get some more demand, we get some more compression on values, and we see some of those things kind of flush through real estate. The people that were able to accumulate in times like right now and still make it work are going to be loving their deals when, rates come back down. But until then, it's a big, as you love to say, it's a big nothing burger.
Yeah, I just don't think it's going to be a really cold day in hell when rates come down, because there's going to be a lot of movement on the real estate side and quickly thereafter the stock market.
Yep. Yeah, supply of new homes in the U.S. crossed above 10 months in May. That's a level we've previously seen only during recessions or the 2022 inflation spike. Home prices are too high relative to demand one way or another. That gap's going to have to get closed. So it ain't closing right now. And I think the catalyst that's going to be the stimulant to compressing that gap, it's going to be rates.
Yeah, cost of capital.
All right, let's roll over to Run the Tape. Trying to come up with some new sections to keep your brain stimulated and giving you some
I'm ready.
Some stuff to talk some shit on. So this is a clip from Iced Coffee Hour podcast. Graham Stephan and Jack, and they interviewed, I forget what his name is. He is a guy on the Dave Ramsey show. Oh. And they asked him if he would...
Already off to a rocky start.
Yeah.
Happy to be flamed.
All right.
As well.
So they asked him if he would borrow $1 billion at 0% interest. Let's hear what he says, and I want to hear what your thoughts are on this.
Would you borrow $1 billion at 0% interest?
I'm happy to be flamed as well from people on Instagram and YouTube comments, but I simply wouldn't do it. And it's not because I'm like trying to be, anti-debt guy. It's because
no, you are.
I live by a set of values and principles, and I have found that living debt-free is simply a better life for me.
That is debt.
So
You don't owe any interest.
if someone else down the road, they can take that loan, and I wish them the best. They can make all the money in the world. At this point, money is not something that I'm chasing. And I think taking on $1 billion loan at 0% to then arbitrage it and make money over here at 4%, it simply doesn't interest me. Even if I could make, how much money would you make? I'm sure you've done the math.
4% of $1 billion?
$40 million a year,
Yeah.
risk-free.
$40. Now, what's the terms of the loan? What's the fine print? We don't know.
Say it's for 1 year.
1 year. So I'd make that 40 million in 1 year, and then that's it. I have to pay the loan back.
Yeah.
And I have to keep up with the payment.
0%.
There is no payment. It's 0%.
And the 40 million is also taxable income.
No.
That's a lot of.
So you
that's
would
a lot
say
of
no to $40 million because you owe taxes on 40? Because
No, I
of
just think
making
it's.
too much
I think it's
money?
more complicated than we're making it out to be
It's
for a
not.
ridiculous hypothetical question.
Absolutely not. And it's people like that retard that keep fucking people poor. I mean, it just is. I don't know what to tell you. 0% interest on $1 billion. Yeah, exactly. I would go put that into a cash instrument for 1 year. And at the end of 1 year, I would sell all of it, pay back the $1 billion, and pay any taxes and laugh my happy ass off. Even if it was 50%, I'd made $20 fucking million risk free. I mean, we just, oh God. So yeah, that type of stuff is the, that's the type of debt guy I'd spit in my hand and slap in the face. That would take it to that level. Like, I don't like that much. It's that bad. It's really terrible. When people are so, it's like religious, but it's almost a cult at that point.
Right.
When you are so anti-debt, even though you've used debt. Dave Ramsey is one of the biggest hypocrites in the game because he used millions of dollars in debt to build his wealth, but then tells people not to do what he did because they don't know how to do it. So again, it's just really dumb. So yeah, that guy, very stupid. I believe the podcast hosts knew that and knew that he would be an idiot and just keep walking down that.
I mean, I figured they knew that he was going to be an anti-debt person, but he would find some reasoning. I think they gave him like
it's a free out,
0% interest.
1 year.
So I was assuming they gave that to him to be like, all right, see, you would come over to our side and take a little bit of debt, because at the end of the day, understanding good debt and bad debt is financing 101 skills. If you're going to learn how to build wealth, a lot of people aren't going to do it with zero leverage their entire life. Most people don't build extreme wealth,
I will tell you,
with zero leverage.
Not possible. In fact, all the people who are typically poor got poor because of leverage, credit cards. They leveraged somebody else's money and didn't pay it back.
Right.
That's bad debt. But if you have $1 billion at 0%,
and even take that down to $1 million, $500,000. I mean, you can find a way to create safe arbitrage through smart leverage and debt,
100%,
and grow your wealth and allow it to compound over time. I think it's just so, to your point, in line with the brand that the Ramsey fanatics have created, that they cannot step outside of that. And I do think that they're doing a disservice. Don't get me wrong. I think there's a lot of people that don't understand bad debt and good debt. And therefore, their default should be some of the basic X's and O's and ABCs of financial literacy, like Dave Ramsey teaches. But I do think that they're also doing a major disservice to a very large subset of their listeners and viewership that have graduated to that next tier. It's like, continue to talk to them like they're kindergartners when they've got their MBA now, and they could be going and getting their, doctorate in wealth building and making a bigger impact on their families' lives and their community and businesses. But they're over here thinking like kindergartners still, because that's the programming and the program, narrative that they continue to push. And I just think that could be something that could transform a lot of people's financial futures if that was a part of their talking points. That's all I'm saying.
Yeah.
You said it a little more brash than I did. Let's shift over to a Meet Kevin clip. He talked about they also asked him on the Iced Coffee Hour, how much do you think an average family nowadays needs to make or save in order to have somewhat of a healthy, sustainable retirement? This was his answer. Knowing that you help so many people plan for retirement, families, individuals, and you're very in tune with what it kind of takes to live. It doesn't need to be some crazy lavish lifestyle, but to sustain a relatively enjoyable lifestyle without penny pinching from month to month. This was his answer. Let's hear it and get your
So
thoughts.
in 2026, how much does someone need to retire with a family of 4?
$8 to $10 million in assets, whether it's real estate, stocks. I think anything lower than that, if you said 40 years old, you're going to run out.
And why 8 to 10? Like, what's the math?
If the traditional financial advice is retire with $4 million, what happens when we have a 50% market downturn? So I'd rather be at 8 and then be at the 4 after the market down.
Here's the thing about most investors right now. They're consuming a ton of content, but they're not actually more informed. They're reading all the headlines, they're watching the tickers, they're following all the noise that mainstream media wants you to follow. And at the end of the day, you're still not informed on what it actually means for your deals, for your portfolio, or for your next move. So if you're listening to this right now, I don't think that's you. I think that you actually want to understand what's happening, how it impacts your investments, what you should be doing going forward, what you shouldn't be, and not just reading about it. That's why I decided to build the Wealth Intelligence Brief, a newsletter sent to you 3 times a week directly to your inbox, where we cut through the noise. We send you the macro data, the real estate intel, crypto signals, and all the unfiltered takes in 5 minutes or less for free. Eliminate the noise, keep the edge. Sign up by texting the word WIB to 844-447-1555. That's WIB to 844-447-1555.
So what are your thoughts on that? I mean,
I
realistic.
don't know who that guy is. That guy doesn't sound like he knows what he's talking about.
Me, Kevin, he's a super eccentric dude. He actually got into real estate and then got into options and stocks and all kinds of stuff. I mean, he's probably got a $60, $70 million net worth-ish. He's pretty transparent and like showing his financials and stuff, but he's
Stay in your lane.
he's a
Kevin.
little out there. So what are your thoughts on that?
Well, if Kevin met Ryan, Kevin would. Kevin, hey man, you should stick with real estate and options since you're probably so smart at that. But you can have, I would say, about 4 million, 3 to 4 million.
And what's your reasoning and thoughts around that?
5% distribution rate. You're not losing 50% in a retirement account for a retiree when they're not happening.
Unless you're completely misallocated, right?
Yeah, that's not happening. You can weather all the downturns. Your money will recover, and then it will continue to grow. So I'm using like a 5% distribution rate. 3 million gets us about $150,000 of passive income. 4 gets us 200. Then they're gonna have Social Security, and then we can increase the distributions. Most people can live on $16,000 to $18,000 a month before taxes. So that's my number. I would say that's the number I try to get to most people, to around 3 to 5 million. But it's talking like that. If you hear people talk like that, indicator, what if we take a 50% loss? Okay. Probably just doesn't know what they're talking about too much. So that's a regurgitator of words, not a thinker or a planner. 10 million would be great. I think if you had 10 million, that's great, but 3 to 5.
3 to 5. Yep. Love that. And before we move on from that, 3 to 5, like, what do you say to the young family, young investor in their mid to late 20s, maybe early 30s, that feels like they're running out of time or doesn't feel like they have a path to getting to that 3 to 5 million bucks? Like,
just don't have a plan. You just are like most people that don't have a plan. We have a way to do that. You can text this line and talk to me, and I can build you a plan. When a plan's built, you are the only one in charge of following it, and you got to follow the plan and stick to it. But it just takes time, just like anything. Once you get to that $100,000+ mark in your investment accounts, you really start seeing the movement a lot faster. The same percentages that got you there start getting you to other numbers really quick. You hit $250,000 fast, then you hit $500,000, then you're at $1 million, and then it just keeps compounding, and that's the compounded interest effect. So don't be discouraged. Just if you're having those thoughts, it means that you either have investments and don't have a plan, or you have the way to make a plan, but you're procrastinating and not making one, and you need to jump off that boat and realize that the water's not so deep.
Yeah, Tony, you can throw that number up on the screen too. Text 844-447-1555. Text the word X-ray. You can connect with Ryan
Come on over
that way. But I always find too, like, anytime I feel anxiety or uncertainty around certain things and like the worry kind of chatter starts to pop up into my head, it's because I lack clarity in it. Like, what if this happens and financially then this happens? Well, once I get like into the nitty gritty of the real numbers and I'm like, oh, okay, that's not actually that bad. And actually, if I just do this over here, that completely mitigates all these things from happening. So it's oftentimes, right, that lack of clarity, that lack of ability to have a vision that you can just execute and like latch onto becomes so much easier. So I love that you brought that up. All right, this is one that we've been talking about for some time. Is the American dream no longer attainable and relatable? Caleb Hammer, do you ever follow that dude?
Yeah.
Dude, he's funny. He goes in on people. I mean, he talks shit on his podcast because he really gets into the numbers of, I think he's the number 3 financial podcast in the world. And he really just dives into like people's finances and like, you're a fucking idiot. You shouldn't be doing that. And what the fuck, like I think you and him would have some great conversation like in alignment with each other because you guys just don't hold any punches when you're saying what you're saying, but you say it out of love. So this was a conversation he's having with one of the Barstool guys around, is the idea of owning a home and it being an asset worth it for younger generations now today? Let's give it a listen.
We have to remind ourselves that, it's the best time in human history for many reasons. There's some downsides.
Oh, yeah.
Cost of schooling, cost of medical, cost of housing, higher per percentage of income than it was during the golden era. But the cost of like food in your income as a percentage and fun, that's all down. And even cost of housing, that's for buying a house. This American obsession with buying a house, you don't need to.
Yeah, so that's a big thing too. It's like, I'm never going to be able to buy a house.
I don't believe that, but also you don't fucking need to.
No, I'm not saying me. I'm just saying, like, in general, you hear that a lot. You hear, I'm never going to be able to buy a house.
Well, that's 25% of Gen Z owns a house, 50% of millennials do. So people are getting there for what it's worth. But go on. Sorry.
No. Those are stats that I think are often forgotten. I don't have them in my head, but I see that a lot, and I see that it's like, oh, I can't even dream of buying a house, but people do end up buying houses. It feels as if there's like these financial goals, and it's in our head. But do you even ever really need to buy a house?
Almost every personal finance person today that is deep into the knowledge of this is like against ownership right now.
Okay.
And I saw some people react that just are still in like boomer mindset of thinking like homeownership is the American way. And historically it has been. They're like, what? This is fucking crazy. It's like, no, you're actually just financially retarded and you haven't caught up on modern personal finances.
So what do you think? We've talked about it a lot. I know you've built wealth by investing in your homes, and you've continued to build, buy up, and you've gained great equity and appreciation. But I also know that you're unbiased to the idea of whether or not it makes sense. You've heard Grant Cardone say it's not an asset. You've heard more and more people say homeownership isn't an asset. Do you agree with Caleb Hammer on this?
Well, it's a liability. There's no doubt it's a liability because it has a cost associated with it, and you're really walking on the majority of your equity. But, I do believe it is an asset, because eventually, if it's if you live in it, you need a place to live. If you want to live in that asset, it will cost you more to rent it than it will to own it. That's a fact. You're not going to get a cheaper asset because you're renting it. It's going to cost, if you buy that asset class, I'm not saying, hey, this person bought this house 30 years ago. I'm talking buy today, rent versus it's always going to be cheaper to own it. It's just harder because there's more upfront costs. And then you could do what I did. And you stair-step your house into bigger houses. I mean, I have a $2 million house on paper, $1.82 million. I owe about $800, and I was able to take $150,000 out of it tax-free, and it increased my monthly payment by a couple $100. So I just don't know why that's not considered. But I'm not saying that renting, investing, everything else doesn't work. You just need somebody to buy a house to do that. So buying a home is a necessity for both of them to work. You're just going to pay somebody else's mortgage and live in their house, or you can pay your own mortgage and live in your house and enjoy the equity every couple of years when you move.
Yeah.
It's too, there's,
I don't think.
no, it's 5 minus 1 equals 4 and 2 plus 2 equals 4. They both work.
I was going to say.
Just, I would argue that, saying home ownership is dead, you don't own a home, and that's why you're saying that. And I would guarantee everybody that lives in that world, or the majority of them, don't own a home. You haven't had the benefit of owning a home. I've dealt with the negatives of owning a home. I have a crack in my fucking side of my house right now I got to deal with on my stucco. Just like I dealt with the positives, where I took out $150,000 against my home's equity for no issue because I had about $1 million of equity. So it's just like, do I want to spend that $150,000 out of my cash, or do I want to spend $400 more a month on my mortgage?
I think your answer was perfect. I was going to say, I mean, I don't think there's a 100% right
Situational
or wrong answer here. I think
Situational.
it's individual to the person, their goals.
But don't be a loser and say because it's
The general
expensive,
statements. And
I'll never own a house. That's lame as fuck. It was expensive when I bought it. Do you think it was easy for me to get married, and then the day after I got married, close on my first house and then move my wife out of the state she lived in? I didn't have a ton of money back in 2019. I didn't. I was doing well, but I was making 6 figures, and I was doing okay. I had to spend all of my money on the down payment, all of it. Then I had to redo the backyard. Then I had to redo that. Then the water heater went out. Guess what? If I wouldn't have done that, I wouldn't have the house I have today. And I probably wouldn't have a kid. I wasn't ready. If you want, there's just different paths. Okay. Both are fine. But you can't say that if you don't own a home, you're not going to be successful. And you can't say that home ownership is stupid and you don't need it. Both are fallacies. Okay. It's like being far right or far left. If you can afford to own a home, it typically pencils out to own a home, and it would be good for you to own a home. If you don't want to own a home and you want to rent, you should be investing heavily with your savings. That's my opinion. There's nothing wrong with either side of those. Lots of people are going to retire on both of those mindsets, and lots of people are going to be successful. But lots of people will be unsuccessful by missing opportunities because something's out of reach. And a lot of people are going to make bad decisions and liquidate assets and realize the value of them if they would have held them. So it's just like, you can't really, my situation is not yours. Your situation is not mine. This is why talking to people who are fiduciaries, me, is important. You need to get unbiased opinions for what is actually in your best interest without having to worry about, is this contaminated with bias? Is this to make somebody's pocketbook padded?
I mean, most everything on the internet is always contaminated with bias, that's for sure. But
that statement, in my opinion, is a low IQ statement.
Well, it reminds me, and I think we can wrap up on this. There's a great quote. I think for a lot of people, whether you're investing in buying your own house, or you're buying a real estate asset, or you're investing in stocks, or you're deciding to invest in crypto, right? Like, learn that whatever it is that you're choosing to invest in, learn to master the skills that are tied to success in whatever that asset or industry is. And whether that's something that you're going to be passive in or active in is up to you, relative to your career, your time, your goals, what you want to invest in. But I do think it's important to challenge yourself to engage in the things that will unlock more fruit in your world and in your life. And whether you decide to make that your daily focus or not, I think those are all tools on your tool belt that make you a more interesting person, that are going to make you more successful, that are going to make you more valuable. And so I just think that, this is a good quote right here. The man who can delay gratification for 5 years and build a true skill and mastery will live the next 50 in freedom. Most people do it backwards. They live free for 5 and they struggle for 50.
Yeah, and I would agree with that.
And I just think that, in the world that we're living now today with so many distractions and so much shit pulling you in all these different directions and quick hits of dopamine and instant gratification, like, just take a step back and go back to the drawing board of the basics. And the basics oftentimes are just like learn the fundamentals before you try and go and expect, being a professional and whatever it is that you're trying to get a professional outcome in. So as always, we appreciate you guys tuning in. We're streaming this every Tuesday. Obviously, if you're listening to this on the podcast, we launch these on Wednesday, but I think we're going to start doing maybe some more like pop-up.
Sporadic ones, yeah.
Yeah, some more pop-ups, maybe like during, Kevin Warsh's speech, we might jump on and do some live reaction videos. Some things that might be a little bit more, instant from, news and trends and things like that. But as always, we appreciate you guys tuning in. Don't forget to reach out to us. Text the word X-ray to 844-447-1555 to connect with Ryan and his team. If you're a passive investor, you want to connect with me and my team on the Imagos Income Fund, hard money lending, collateralized assets, being the bank with us, and getting monthly paychecks. You can text the word income to 844-447-1555. As always, we appreciate you guys tuning in. Keep investing in yourself and your wealth on your march to $1 million and beyond. We'll see you guys in the next episode. Cheers.
Cheers, y'all.